Kitco News special coverage of the New Orleans Investment Conference is brought to you by Uranium Energy Corp., Uranium Royalty, Gold Mining, and Gold Royalty Corp.
We're at the 47th Annual New Orleans Investment Conference, one of the most preeminent gatherings of private investors from across the country and around the world. I'm Michelle Makori, and joining me now is Mike Larson, Senior Analyst at Weiss Ratings and editor of the Safe Money Report. Good to have you with us, Mike.
Glad to be here.
All right, Mike, I want to start off with some breaking news. We've just learned that the Federal Reserve is now going to ban policymakers from owning individual stocks and restrict trading. That's following the controversy. We had disclosures that some Fed officials had been buying and selling stocks whilst making Fed policy in the middle of this COVID pandemic. What are your thoughts on that?
I mean, it's not surprising, I think, that this was going on. I think it might be surprising that it took so long for it to come out and be reported on. I mean, and let's be honest, the Federal Reserve in the last couple of years, really going back to 2008 and 2009, has gotten so much more entrenched in the capital markets. It used to be they just bought and sold Treasury securities and sort of operated in the background. But if you look in the wake of the financial crisis and in the wake of the COVID crisis, what have they tied themselves up into? Corporate bonds, junk bonds, not just treasuries, mortgages. They've been bailing out or backstopping all kinds of asset classes. So what you have now is even trades in mutual funds or ETFs or as you mentioned, individual stocks that some regional bank presidents may have done or others on the Fed may have done. It creates that sort of image or that look that this is a conflict of interest. So again, I think it's just part and parcel of the Fed being involved in so many corners of the markets and now sort of being caught and saying, okay, we've got to do something to at least look like we're not focused on that, not focused on personal gain. So this is all wrapped up in that.
Yeah, you would think that some kind of regulation of this nature should have been implemented sooner, but does it speak to the broader trend or notion that there is a loss of faith in the Fed?
Oh, absolutely. I mean, again, when the Fed goes down this rabbit hole, gets so much more involved, you see all the anger over the bailouts in 2008, 2009, and so on, and saving Wall Street and big firms and everything. There was a lot of populist anger about that, right? Now, coming out of the COVID crisis, while people certainly were happy that something was done to stabilize the economy, these kinds of reports, this kind of news only does sort of create that image in people's heads that, Wall Street, the Fed, they're in bed with each other. They're willing to do things that, might help Wall Street, but not Main Street. And this certainly does create that image concern. It does create that sort of perception that the man and woman on the street aren't getting the same access that we're seeing on Wall Street.
Yeah, sort of feeds into this idea of a world gone mad, which was the theme of your presentation, windfall profits and income strategies in a world gone mad. So break it down for us why you describe that the world has gone mad.
Yeah, I mean, if you look at what's happened in terms of fiscal and monetary policy, so what the Fed's doing, as well as what the Biden administration, and even in the tail end of the Trump administration as well, what's been proposed or already enacted in terms of money printing, borrowing and spending, stimulus, and so on. We're throwing out trillions and trillions and trillions of dollars, numbers that are virtually unimaginable, really on the scale, when you look at sort of relative to the economy, it's almost on the scale of what we did during World War II and after World War II, focused on an obvious enemy there, in this sort of battle for democracy. Now it's like the resources being thrown at the COVID pandemic and the recovery, and then being left in place even as the worst of the COVID pandemic has passed, they're unprecedented. So it's a world gone mad in the sense that we're printing and borrowing and spending untold trillions of dollars, again, on a scale that's almost unimaginable in peacetime. And what's happened in the last year is, even though the markets have soared off of the COVID low, even though we've seen house prices going up at rates faster than we saw at the peak of the US housing bubble, even though everything from artwork to NFTs and all these other esoteric assets have been ballooning to the point where people are spending $3 million on a digital picture of a rock, we're still leaving in place all this money printing, all this stimulus. And that's what's different. We're not withdrawing, even as the economy and the markets are doing very well, we're not withdrawing all that extra federal help. And that's creating risks and opportunities.
Well, let's first of all focus on the potential withdrawal. Do you see some kind of pullback happening? I mean, do you see the Fed sticking to starting to at least taper in November?
I think the Fed is trying to put those feelers out there. They're trying to take those first tentative steps. And so we could see in November the Fed say, okay, starting in December, we're going to maybe dial back, let's call it $5-10 billion a month or whatever they do. But we ultimately have to remember, they're not stopping buying a hard stop, and they're not actually selling anything they've already bought, right? It's a dialing down of the pace at which they're acquiring more assets. Plus, they're doing it even as there are some indicators that in the fourth quarter, growth is going to slow. There are indicators like employment growth, for example, which have been well under expectations the last few months. And we're seeing much less growth than we saw back in May and June and so on. So it could be a case where the Fed is trying to sort of dial things back at the same time the economic data is worsening. So that's going to be one of those things that ultimately the Fed may be forced to say, you know what? Let's give it a few more months, or maybe a few months longer than that, because the numbers aren't going to allow them to get through that.
And that's just tapering. As we know, rate tightening is way, way, way out on the horizon. The Fed is, of course, one thing, but as you said, unprecedented monetary and fiscal stimulus. And we anticipate more from DC, with the Biden administration still pushing for this infrastructure bill, and also potentially this reconciliation bill. Not entirely sure which aspect of these gets passed, but I think it's safe to assume that we will have further stimulus injected into the economy. So going back to your premise of your presentation, how do we make windfall profits and income strategies in this world gone mad with excess stimulus? What do you recommend?
Sure. There's a couple different things you can do. First off, for sort of your core portfolio, you want to be focusing on higher dividend yield companies that are giving you dividend growth, dividend yield that's better than the market, and that allow you to push back in this world. I say we're in a LERP, ZERP, NERP world. Low, zero, negative interest rate policy world. This is a world where the Fed, as you pointed out, when they do get around to hiking, it's going to be down the road. When they do start, it's going to be less than I think people are expecting. And the ultimate level that rates get up to is probably going to be lower than people are expecting. So it's an environment where rates are going to remain very low for very long. You want to be focusing on yield. You want to be focusing on companies that are growing their dividends to help you beat that environment.
So let's focus on the equity side of it first. When you say companies focusing on dividends, do you have any particular specific picks?
Yeah, absolutely. We use the Weiss Ratings methodology to screen on a number of different factors for income. And some of the names that recently have passed those tests, Fastenal is one of them. The ticker symbol is FAST. They're a company that does industrial construction supply. They supply manufacturers. They have some on-site vending machines where if they need a tool or something, they just buy it right there, or they order online or do it through distribution. The yield is not fantastic. It's about 2%, but that compares favorably to the S&P by about 50 or 60 basis points. And it's a company that's going to benefit from some of this largesse and this spending that's coming out of DC. I mean, I always say I can't change the policy choices that they make in Washington. I can only do my best to help investors profit from them. And a company like Fastenal is going to benefit from that money thrown at these sectors of the economy and infrastructure and so on, and do it in a way that's also spinning off dividends and a company that gets a solid Weiss rating. So that would be one example.
Another example, while we stick to the equity theme?
Sure. You've got a company like CRH. They're a construction supply company actually based over in Ireland. They operate worldwide. They're not just in Europe. And they're a company that a lot of heavy materials, things like that go into construction, a nice yield there as well, above 40, 50, 60 basis points above the S&P. And they've got a decent Weiss rating and an outlook that, a positioning in the market that says, if we're going to see more spending on this stuff in the U.S., if we're going to see potentially even some spending overseas, CRH is a company that's going to benefit from that. And it trades here in the U.S. As an ADR as well, so easy to buy.
So those two equities that you mentioned, how do they get impacted by the rise in energy prices and the supply chain issues that we're facing and inflation?
Yeah. There are companies that, just like much of corporate America, are dealing with, rising labor costs. They're dealing with sourcing commodities and things like that, where the costs of just getting things from point A to point B are higher. But they're then passing on a decent size of that, or a decent amount of that, to their customers. They're raising prices. They're compensating for that. So while they may have short-term margin pressures, that inflation, those economic issues that they're facing are ultimately going to be passed on to the consumer. And I think that's going to help keep profit margins longer term in decent shape.
Right. But now, beyond equities, What are your other picks for windfall profits and income strategies in a world gone mad?
Sure. I think there are certain things you can do, like selling options for income. That's one thing we've talked about recently. It's a way of sort of, instead of buying options where 80% historically of purchases have failed, you can turn around and sell options for income. You take in the premium, and that can boost your portfolio's income. That's one thing we look at. And then on the precious metals side, I think we've been in this market where people have tended to say, okay, when is gold going to do something? When is silver and when are the mining shares going to do something? Because we've been in essentially a year-long sideways pattern. But if you go back to the start of this bull market in 2018, you already had 2 or 3 corrections that last, you had to run up a correction for 3 or 4 months, and then it was the next leg up, and then another correction. This, to me, just looks like a longer version of what we've already seen. It does not look like a reversal. And when you think about a central bank that's going to be reluctant to raise interest rates, when you think about a market that inflation numbers are getting much stronger, and when you think about real interest rates, once you factor inflation, we have negative interest rates, very deeply negative interest rates in the US. Historically, that's been a great environment for precious metals companies. So I think this is more of a extended pause versus a reversal, and it gives you a chance to get in on an asset class or on assets that remain cheap versus extended housing versus many stocks that have been taking flight already and so on.
So precious metals miners, or are you also advocating buying spot gold and silver, or gold and silver ETFs? What specifically are you looking at?
I would say all of the above. I say that depending on how much money you have available, if you're just starting off, there's nothing wrong with paper gold, an ETF or something like that if you're just starting off. The larger dollar amounts you're talking about, that's when you want to be doing things like bullion, coins, and looking into mining shares for that leverage to rising metals prices. So again, I think it really just depends on how much you, the individual, have to invest. The larger your portfolio and the larger the amount you're allocating to gold, the more you want to be drilling down, pardon the pun, on some of the juniors and some of the the higher risk, higher return sectors, and the more you want to be focused on physical versus, say, ETFs.
Okay, before we go back to the physical, if you look at the ETFs of some of the mining companies this year, they've underperformed the S&P and by double digits.
Yeah.
So how do you justify, that's not trading sideways, I guess that's underperforming. So how do you justify this notion that you think they're all of a sudden going to rally?
Sure. If you look back at what was happening in the late cycle pre-COVID environment, 2018, 2019, you saw vast outperformance for metals and mining shares versus the S&P. Now we're in the situation where the script has been flipped because, again, people are more interested in paper assets and so on. But I think ultimately it's just a question of patience, right? Can you ride that out? Can you be a patient investor, realizing that down the road that patience is going to pay off? I don't think you own all just mining shares or gold and no equities. We certainly have, as we talked about already, ways you can profit in the meantime in just general stock market investments. But I think ultimately, if you're in a world where many assets are overvalued, where real estate is extremely highly valued, stocks are extremely highly valued, and so on, and go down the list, what hasn't run up? What hasn't yet sort of benefited from that? What remains relatively cheap? I mean, the biggest, most obvious answer to me is precious metals and, of course, the shares of the companies that mine them.
And when you say patient, how patient? When do you expect a serious turnaround and an uptrend, and what do you think would trigger that?
I think that there's going to be a realization as we head into the sort of turn of the year in early 2022, where people are going to realize this Fed's not going to be able to be aggressive. I think there's sort of this fear, right, that this is going to be like we had in the last Fed hiking cycle, where all of a sudden metals are falling and the Fed's getting behind the curve and they really want to be aggressive. Or even if you go further back to previous cycles that may have been negative for metals, I think people need to realize this is a Fed that is very tentative. It's a Fed that has a lot of political pressure to favor the employment side of its mandate over inflation. And especially under this administration, again, the Fed tries to say it's not political, but we can't, they're reading the same headlines, they're getting the same pressure that you're seeing elsewhere. So why would they come out, especially if unemployment growth is starting to slow, or especially if GDP trends a little bit lower? What motivation and what what reason do they have to be aggressively hiking interest rates? And I don't think it's going to happen. I think that we're going to see, and investors, mainstream investors are going to appreciate, this is not like past Fed cycles. So the short answer is, as we head into next year and get sort of halfway through, I think we're going to see a lot of catch up. We're going to see that next move up in gold and silver because people won't have to fear the Fed so much anymore.
So what's your 6-month outlook on gold and 6-month outlook on silver?
Sure. I think that we're, the sort of blow-off highs that we saw, 13, 14 months ago in gold, that big run-up in gold and silver, I think that is likely to be eclipsed next year. I don't think it's going to be a runaway where you're talking about $4,000 gold, but, 22, 23, 2,400, somewhere in that range. I think, and sort of a corresponding move in silver, I think it is likely on the table. And again, it's going to come from that release of that Fed fear pressure valve, whatever, that's been keeping people from getting involved.
You mean the fear that the Fed will actually step up and do something?
The fear the fear the Fed will be too aggressive. Will get out there and stamp out.
Are people really thinking that the Fed is going to be too aggressive at this point? Do you think that is what's been holding gold and silver back? Concerns that the Fed may step it up?
I think if you look at what's happened in the interest rate futures market, you have seen, if you compare today or the last week or two relative to what we saw 6 months ago, there's definitely more pricing in of initial rate hikes a little bit sooner. The date that the interest rate futures market is pricing in has advanced a little bit. We've seen banks like the Bank of England kind of lay the groundwork for a potential hike, and that had people a little spooked. But ultimately, again, I think if you get in the head of the people that are making policy for the Federal Reserve, and you see sort of the backdrop of an economy that may not, maybe running out of some steam here in terms of, not heading into a recession, but running out of sort of the high growth we were seeing for a while, it all adds up to a Fed that, in my opinion, is not going to validate those fears. So I think once people acknowledge and realize that, that's going to set the groundwork for a better start to next year.
So 6 months outlook for gold, you said 2,300.
Yeah, I think we're in that ballpark.
Silver?
Corresponding, if you go back to sort of those highs, I think that, silver, especially if there's some concern about the economy, we might not get much higher or sort of in the ballpark of those highs we had last year, but somewhere in that same neck of the woods.
And I'm going to put you on the spot because our viewers love a 5-year outlook. They're very patient. So do you have a 5-year outlook for gold and silver?
I wish my crystal ball would see that far out, but the way I would answer that rather than give a price level is I would say if you look at the bull market for precious metals, in my opinion, it started right around the second half of 2018. And in baseball terms, we're maybe in the 5th or 6th inning. So you can extrapolate from that. I don't think that this is a market that, again, is going to continue to underperform much further. I think that long term, the outlook's very bullish. And I would just say, again, this isn't the 9th inning or anything like that where it's time to sell. It's time to get ready for that, that tail end, which we've seen in past historical bull markets. That's when you tend to see the bigger gains, when you get into sort of like that back third of the market.
All right, Mike, thank you so much. Appreciate your insights. Thank you for joining us on Kitco News. Mike Larson.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Uranium Energy Corp, Uranium Royalty, Gold Mining and Gold Royalty Corp,